Alright guys, I missed you, but now it's time to build the YouTube empire back up. So let's talk a little bit about accounting here. So this is review, this is something we've covered, but let's nonetheless remind ourselves what we were talking about. We're talking about revenue recognition, talking about when you would record revenue. Again, we know these things, it's recorded when it's earned. It doesn't matter when you pay for it, doesn't matter when you promise it, it's all about when you earn it. So we provide a service on account. There you go, you're going to debit the accounts receivable or the cash, you're going to credit sales, bingo, revenue. We receive a deposit for future work, we haven't done it yet, so debit your cash or credit your customer deposits or unearned revenue, very similar, okay? Client is going to pay us in advance for the service later, same thing. Debit your cash, credit your unearned revenue, okay? And then if you perform a service that you were previously paid for, so like in those prior two examples, well, now you're going to debit your unearned revenue or customer deposit, depending upon which one you recorded it as originally, and then credit your sales. The work is done. All right, so what about net pricing? We talked about it as the buyer, we could use the net method when we're purchasing inventory, assuming a discount. When you're the sale, though, you can't really do it because you need to keep track of the discounts for one thing. Figure out which discounts your customers are taking. Make sure your policies are sound. And we have control over that policy. However, we have no control over whether the customers pay within the stated date for the discount. Since we have no control, no net pricing method on the sales side. And there you go. Don't forget we can control our own discount destiny as the buyer. Why don't we just debit sales for return or allowance? Good question, but in terms of the answer, we got to track it. We want to be able to know exactly how much money we're losing in discounts and how much is being returned. Again, Walmart probably has a little bit of a higher return rate than a number of other companies that are out there. All right, so what if we sell goods and not a service? Well, how does that change the accounting? Very minor. So in terms of when we sell, we're going to debit accounts receivable like we did before. We're going to credit sales like we did before, but that's only half the transaction. We need to include a debit to cost of goods sold and crediting our inventory because we're assuming perpetual inventory method in this case. Again, we need to figure out not just how much our sales were, but how much is the inventory that we sold. So here's an example. If we made a $1,000 sale, the inventory is valued at $600, and we sold at terms 210 net 30, what accounts are going to be involved? Well, the accounts are going to be the same as above. In terms of the amounts, you're going to have the accounts receivable and the sales going for the $1,000 because it was a $1,000 sale. Your cost of goods sold and your inventory, they're going to mirror each other with the $600 because that's the value of the inventory. Well, let's continue on this one quickly. Our customer returned half of the sale, exactly half of the inventory. So $500 worth of the sale and inventory that's valued at $300. So the accounts we'll use that debit, sales, returns, and allowances, and hopefully you remember that's a contra account. We're also going to credit the accounts receivable for the $500 because they're going to owe us $500 less. In terms of inventory, cost of goods sold, you kind of flip the transaction. You put the inventory back in with a debit to inventory and you credit out cost of goods sold. There is no contra account for cost of goods sold. It is just that account. And then let's say the customer goes ahead and pays on the 9th day within the discount period. There's your sales discount of $10. You can see it's the 2% discount that we offered times the $500 that is still remaining on that sale. The cash is going to be the difference, which is the amount owed minus the discount. And then we're going to credit out accounts receivable for the $500 because unlike my little brother, unlike John, unlike my friend Tyler, they no longer owe us anything. Unlike Jed, no longer owe us anything. All right, guys, hopefully this makes sense. If you have questions, feel free to let me know. If not, good luck knocking out the problem.